When the Q4 dump really starts. Intro, hook. Everyone expects a Santa rally. But what if Q4 becomes the worst quarter of the year instead? Here are 7 warning signs, plus 3 political monetary wildcards, that could trigger a brutal dump. Watch closely. Don't get caught off guard. 1. Earnings and guidance cracks. Companies stop issuing beat and raise. You begin hearing miss and cut. Forward guidance is pared back. Profitability forecasts get weaker. These cracks in fundamentals often precede broader market breakdowns. 2. Rate expectations shift. Fed policy whiplash. The Fed may cut rates to stimulate growth as the economy softens, but cutting too early or too aggressively can ignite inflation fears or credibility risk. Some Fed officials are cautioning against aggressive cuts despite economic softening. Reuters +1 markets also price in fewer cuts than expected when inflation lingers. Volatility jumps. 3. Liquidity and credit stress. Repo rates, interbank funding, corporate credit spreads all start acting up. Junk bond yields widen. Banks become conservative. The deeper this stress becomes, the more it will metastasize into equities. 4. Overleverage and speculation bubble. Margin debt surges. Retail and leverage funds overextend. Meme, story stocks, run well beyond fundamentals. When the music stops, there's no safe chair for many exposed. 5. Weakening breadth and technical divergences. A handful of megacaps carry the index upward while most stocks lag. Indicators like Hindenburg Omen, divergences in MACD RSI, skewed breadth show instability. Volume confirms that important moves are weakly supported. Bad sign. 6. Macro and economic deterioration. Leading indicators roll. PMI, new orders, housing, retail, capex. Employment weakens, wage growth stalls, credit defaults drift upward. The downturn begins in sectors before hitting the headline numbers. 7. Sentiment complacency and extremes. Buy the dip becomes reflexive. Any pullback is considered opportunity. Media hype, IPO, SPAC flurry, speculative mania. Valuation metrics go off the charts, PE cape despite weakening fundamentals. Bonus wildcards and catalysts to watch. These aren't just warning signs. They can trigger or amplify the dump if they hit at the wrong moment. A. Fed rate cut, when too soon becomes dangerous. If the Fed cuts in Q4 to stimulate growth, it may spook inflation hawks or bond markets. The market could interpret an early cut as panic, which undermines confidence. Also, rate cuts may create false optimism, pushing valuations too high before the fundamentals collapse. B. U.S. government shutdown, fiscal breakdown. A prolonged shutdown delays critical economic data, jobs, inflation, that the Fed uses. Reuters +2. Investopedia +2 agencies like the SEC, CFTC, etc. may be curtailed, slowing down regulatory oversight and corporate disclosures. Reuters Trump's administration is threatening mass firings instead of normal furloughs. That adds unpredictability. Business Insider +2. Reuters +2. Even short shutdowns can erode consumer confidence, spending, and momentum. C. Trump. Firing a Fed member. Political interference. The move to fire Fed. Governor Lisa Cook has rattled markets over Fed independence and credibility. Center for American Progress, +3. AP News, +3. Reuters, +3. Markets have already reacted to rumors of ousting Chair Powell. One study estimated up to $1.5 trillion in market value could be at risk in a full dismissal scenario. Investopedia analysts see murkiness. Some expect weaker USD and lower yields, others warn curve steepening or inflation risk. Reuters, +1. Removing or pressuring Fed officials destabilizes expectations and injects political risk into monetary policy.